Downside risk for the US dollar may be growing. Progress in peace talks between the US and Iran has unwound the geopolitical premium embedded in energy markets, taking oil and treasury yields lower alongside the greenback. The more interesting question today, however, is whether the Fed will amplify those downside risks. The Fed funds curve still has 27.5 basis points of hikes priced through to June next year. That's a very different profile to the Fed's projections from March, which pointed to two 25 basis point cuts from current levels by the end of that year. While dollar bulls will argue the Fed is likely to ditch its easing bias today, that should hardly come as a surprise given recent remarks from influential FOMC members such as Governor Christopher Waller. And perhaps more importantly for dollar directional risk, unless the Fed believes we'll see a wage breakout like we saw in 2021 and 2022, it's difficult to see them validating current hawkish market pricing. U6 unemployment, a broader measure of labour market underutilisation shown on the left, has been edging higher in recent years, while wage growth shown on the right has slowed over the same period, creating a very different backdrop to what was seen coming out of the pandemic. AI may also create dovish risk, allowing the economy to sustain stronger growth without generating inflationary pressures. Yes, the build-out is undoubtedly inflationary in some categories in the near term, but we've known that for a while. Productivity gains, however, is the wild card, potentially altering the relationship between growth and inflation, reducing the need for the Fed to hike rates. Newly appointed Fed Chair Kevin Warsh has been vocal in arguing precisely that. While there's no guarantee the broader FOMC will fall in behind his view, the Fed's March economic projections suggest that at least some members may already be subscribing to a similar view. Despite the inflationary backdrop at the time, the meeting year-ended growth projections were revised higher, suggesting policymakers believe the economy could continue to expand at a solid pace while unemployment remained low. As such, while I think cuts this year will disappear from the Fed's updated projections, easing may still be seen in 2027 and 2028, with the longer run dot remaining anchored around 3%. If my hunch is right, it would represent a more dovish outcome than markets currently have priced in, likely forcing traders to unwind some of the hawkishness embedded into the curve and adding to downside risk for the dollar. The correlation matrix helps explain why. Fed pricing has been one of the dominant drivers of the US dollar in recent weeks, with the 20-day rolling correlation with the DXY sitting at 0.69 and strengthening to 0.98 over the past 5 days. Treasury yields tell a similar story, with the 5-day correlation between the DXY and 2-year yields sitting at an eye-watering 0.99. So, if the Fed fails to come across as hawkish as markets are, the recent decline in the US dollar may have further to run. Best of luck with your trading. I'll catch you next time.